Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and welcome to Thursday, January the 5th. And I'm falling. There you go. Had to readjust my chair. 800-951-0592. AllAmericanGold.com is the website. We got jobs data today. We got to go through all of that. We're going to get the government jobs number tomorrow. We have a big sell-off on Wall Street. Gold and silver, we're seeing profit taking there as well. Copper, though, defying copper, approaching that $4 level once again. And lo and behold, Joe Biden is going to visit the border. Yes, he's going to the U.S.-Mexico border. I didn't even know he knew where that was. But apparently, at least as far as the Biden administration goes, Jason, we still have a border.
Yeah, there hasn't been a whole lot of real stopping of people coming over the border for a long time. So, and Joe Biden's no different. He's here in Colorado. It's a nightly news story about the migrants in Denver and housing them and keeping them out of the cold and getting them fed. And it's a part of today's society, Joe. What do you do, man? It seems like everything's backwards.
Yeah, it is kind of interesting. Texas, Arizona, we deal with tens of thousands, hundreds of thousands, into the millions. I think the 2022, almost 3 million across the border. And these blue cities, they freak out. Oh, they sent us 900 migrants. They freak out. I just laugh. But tough day, tough start to the day. All about jobs. We had ADP today. Normally we get that on Wednesday, that first week of every month, that Wednesday, Thursday, Friday, it's all jobs. ADP, which is private. This is a non-government entity telling us how many jobs got created. Then on Thursday, you get first-time jobless claims. Today, we got both of those numbers. And then tomorrow, we're going to get the number from the government. ADP number came in hotter than expected. 235,000 jobs created in the month of December. And again, that was hotter than expected. They were looking for about 150. Now, the ADP number has been a lot lower than the government's numbers have been, especially over the last 3 to 4 months. But it's something where, again, we've been saying this over and over, Jason. It's all about jobs. How fast these rate hikes come to an end really is dependent on how quickly people start losing their jobs. We did get layoff announcements. Salesforce laying off 8,000. Amazon up their job cuts to 18,000. Bed Bath & Beyond. Listen, Bed Bath & Beyond, I don't know if they'll make it or not. We'll see. Numbers out of Bed Bath & Beyond, not very good. They've already been closing stores. We'll see if they survive. That's kind of our first whiff of retail. Stitch Fix, they're going to lay off 20% of their workers. I know this. The tech layoffs, Jason, are absolutely going to continue. The question is going to be, is it going to spread into retail? Is it going to spread into leisure and hospitality?
Yeah, Bed Bath & Beyond, I think, is a good example because not only are we looking at hard economic times ahead, but also that store seems like it's one of those stores that's going to really lose being brick and mortar, because it seems like a lot of stuff that's in their stores, a lot of people are shipping to their home now directly. So they got kind of a double-edged sword going against them that nowhere really for them to escape. It's kind of how Sears went down. Everyone just started ordering this stuff through the mail, right, Joe, and shipping it. That store's not, I would say this, closing some stores. I'll bet by the end of the year that we're talking about closing almost all their stores.
Yeah, that's going to be the question. I think for them, the question is going to be, are they going to be able to survive here. I think another bankruptcy is probably imminent for Bed Bath & Beyond. Shares down 23% today. And the news, just really simply, they've got a lot of debt. They've got interest payments due in 2024, 2034, 2044. I mean, and without the sales, we'll have to see losses, about $1.2 billion in losses. They anticipate net losses to jump nearly 40%. And so we'll see. And again, this is probably one of those things, let's face it, when you have X amount of dollars a month, shopping at Bed Bath & Beyond, that's more like a luxury. That's things you don't, hey, I don't have to have a new pillow, right? I don't have to have what holiday plates or the deep fryer or whatever else, the back massager, right? Those are luxuries.
Lots of conveniences. Yeah, they sell a lot of conveniences at that store, a lot of things that make life comfortable, and it's getting really uncomfortable, and they don't sell a whole lot of solutions for being uncomfortable in a basic way, right, Joe?
Yeah, absolutely. We did get our first, so we've been waiting for some retail numbers. We haven't seen very many of them, but we did get our first look at online holiday sales. And that number, I'll say this, not a great number. Especially with the inflation. We'll tell you about that. And then we got to talk about jobless claims because we also got that number. Patriot Radio News Hour. Stick with us. We'll be right back. (800) 951 0592. Joe and Jason here. Patriot Radio News Hour. We're talking, Bed Bath & Beyond, the first sign anyway. And of course, Bed Bath & Beyond, it's a weaker retailer to begin with, but holiday online sales was only up 3.5%. So that's a number that has to be disappointing, especially, inflation is at least 7%. So only up 3.5 according to Adobe Analytics. Overall spending over the holiday season, of course, Christmas fell on it. Really, they had everything in favor for them, Jason, because Christmas was on a Sunday, so you got the whole weekend, that Friday, Saturday to get those last minute gifts. So pretty disappointing online number, and they said a lot of
Joe,
it,
is that 3.5% from last month or 3.5% from last Christmas?
Yeah, it's fine. We're talking about from holiday, the holiday. So from Thanksgiving to Christmas, that whole time.
Got it. Okay.
Frame. So
that's what I wanted to know, Joe, because that could be a tough number to get.
Yeah, the Black Friday number, and think about it. Last year, people still had a lot of that COVID money. They didn't have this year. So
right. That's what I was going to say. It would be surprising if it was up from 2021. That's why I wanted to make that number clear, because sometimes you got to understand where that number is coming from.
Yep. Only up, like I said, 3.5. Electronics, jewelry, things like that were actually down. Computers, TVs, sporting goods. A lot of the sales driven by deep discounts as well. So again, I think we're going to see that pressure on the retail side. It's going to be interesting because we've been talking about, are we going to see the layoffs? When are we going to see the layoffs? We got jobless claims today. The number came in at 205,000. That is down from 223,000 the previous week. So this really, between ADP's job number and the jobless claims number, that got the spook into the market that, I think a lot of market participants were hoping February would be the last rate hike. Now they're like, these numbers are too good. We're going to see more rate hikes, higher for longer. Here's the interesting part in this. The unseasonally adjusted numbers. 275,000. Unseasonally adjusted last week were 270,000. Now, I don't know how much the seasonal adjustments are supposed to add or subtract on any given week, but it just seems like, wow, you're going to discount like 25 to 30% of the job. It just seems like a big number because that unadjusted number, 275,000, that number's up there a little bit.
It's moving a little bit. It just seems just creeping. It's the last bunch of months, Joe. Just every time you give this number out, it's just kind of creeping up. It's not blowing us down, but now that the holidays are over with, we'll have to see the next couple of months, Joe. It seems like it's all being timed and ready to happen by February, March type of time frame when these things really start to nosedive.
Yep. So there you have it. This is kind of the start. The Dow down 400 points. The S&P's down 42. The Nasdaq's down 120 points. Gold's off 20, 1836. Silver's down 60 cents at 23.36. We still got that sale going from yesterday. Really super hot pricing on silver dimes and silver eagles. The dimes at 110, the silver eagles at 730. Take advantage of those things. And again, if you're worried about volatility in the market, I know you can always call my son. You can always call Joey. Make sure your 401ks are right. Make sure your assets are protected. 602-909-9048. Of course, or Jason, if you don't want any part of this market, you're an accredited investor. You got $50,000 to invest. You got to check out our friends at YRefi. Huge returns. You can have up to 10.25% returns guaranteed, not tied to Wall Street. It doesn't matter. You know, we had Joey on a couple of weeks ago, and he was talking about, Jason, at Northwestern Mutual, they expect 2023 to be another ugly year. So if you want something not tied to Wall Street, invest YRefi.com. That's the word invest, the letter Y, REFY.com, or call 888-YRefi24, 888-YRefi24, and let them know that Joe and Jason sent you. But to give you an idea of how worried the markets really are, because, you know, the Dow, probably not a great indicator of how worried. Really, when you look at the bond market, today we have a tiny tick up in yield. Not even 0.3%, 0.02 at 3.73, and we know the Fed's funds rate is between 4.25% and 4.5%. And Neil Kaskari was out yesterday, Jason, saying, "Listen, we're going 50 more basis points in February, right? We're going to do 50 basis points in February. So now you're talking 4.75 to 5.5, and the 10-year note is only yielding 3.73. That just tells you that there's a lot of angst, because here's the problem with the size of all the debts. Think about all the collateralized debts these banks are holding, all these derivatives. You think about the national debt, you think about the Fed's balance sheet, all of these debts. It won't take a lot of Bed Bath & Beyonds Jason, to create a problem. And again, if people really start losing jobs, that's going to be something where, you know, does that really create another housing crash in price? Because a housing crash in price is just as bad to the banks as it is as far as businesses going under.
Yeah, you know, the one thing is I keep thinking they're not going to go down to just a quarter point hike, but you do keep hitting the jobs need to be a more severe situation. So I guess if the jobs number, maybe even if the CPI number comes down, which I think it will, as they're trying to have this, you know, this victory over inflation, that they're going to try to, you know, fake people into thinking they got it under control. But if the jobs numbers don't, if they don't get bad enough, Joe, I guess you're right. It will have to be a half a point in February because they need to push that in that direction so they can get the result they need, Joe. So very, very interesting.
Yeah, and again, right now, at least today, the numbers that we got today, not conducive to rate hikes slowing as quickly as some may hope. Now we got other, right? We got retail sales online, not great. Bed Bath and Beyond, I don't think people were really necessarily surprised by them. We'll have to wait and see. And of course, remember, tomorrow we get the government's number, and those numbers, they've been very erratic between ADP and the government's number. So it's going to be interesting. The pattern as of late is the government number's been higher, Jason, than the ADP numbers. And I think that's what the market's worried about today is if ADP is saying, 250,000, man, is the government going to come out and say 350 or 400,000? I think that's what they're worried about.
Yeah, and the housing prices, as you're saying, Joe, if you get a huge amount of job losses, you would expect the housing prices to drop. However, I got an email. I won't go into his full name, but Jeremy knows who he is. He works in the housing market. It's just a little quick thing is that this is one of those things, Joe, where remember I keep talking. I think we're heading towards a type of small version of the dark ages where you end up with peasants and lords. No business class. The middle class goes away. I think we're headed straight for it. And this is kind of what I look at when I think this. Just what he wanted to say, he's done some repossession work for HUD, learned quite an interesting little new factoid. Although there is jumping treasurer notices and a lot of foreclosures action happening, much of what is behind the scenes is being dispositioned quite differently than previously. I've had several big shot realty people tell me that a big hedge fund is picking up all the discounted and distressed properties, all of them. It is happening through asset management companies as well as HUD and FNMA. I've heard from several different sources, several different locations. So hedge funds, kind of quietly coming in, Joe, and scooping up what's probably a problem that's already here. And the housing prices aren't crashing because, someone wants to buy everything up. I think, Joe, they understand.
Well, you're buying if we're talking about foreclosures. So they're going to be buying them at a steep discount, no doubt about that. So it's going to be interesting is if we get the people that bought houses in 2021, 2022, if they start walking away because those loans are not favorable right now. It just depends on where they're at. And I know this. Bankruptcy, they're starting to happen a little bit here. It'll be interesting if it becomes a big number, if they're going to be able to do that, because I'll say this, the big ones, BlackRock, Blackstone, Jason, they're facing redemptions. People want out. BlackRock today announced that they're suspending their redemptions, saying, hey, you know what, you guys want out, but you know what, we've got, y'all, it's always the fine print, isn't it? Right. Well, in the fine print, I know we told you could get out, but you know what? If everyone all wants to get out, then we can tell you can't.
Right, Joe. I guess the interesting part of the buying of the homes, if we're going to have market downturn and housing prices going down, why buy them now? Why not buy them later? I get the feeling that the big companies know that this inflation will come back and that a new home build could be $500,000 later this year. And what if that happens? Then you scoop up everything you can get right now. Anything that's distressed, you scoop it up because, housing prices can crash and they can go down, but that can go sideways. If the inflation is 20% or 25%, it's raging, and housing prices go sideways. That's a housing price crash. And so these are cheap houses, and it's, I think what we're going to see in the next couple of years is a type of market situation we've not seen because the debt is so large versus the 70s and 80s when we had the big inflation, Joe. It's a different situation. We're going to see some things that are not the same as the 70s and 80s.
It's going to be really interesting. Again, I'll go back to jobs. If people don't lose their jobs, and right now, listen, I'm not seeing it. And I've said it a bunch of times. I'm not seeing it. They're just not there. Now, can it happen immediately? Yes. Right after the holidays, let's see what's left. But to Jason's point, listen, if we don't get these layoffs, because I'm going to tell you right now, the era of cheap oil, this is it. Once we get past January and into February, cheap oil goes back. We're going to see $100 oil again. We're going to see prices rise at the pump again. We're going to see a lot of that stuff. And to Jason's point, we need the job losses to prevent it. And if we don't get it, Jason, we're in this scenario where, again, and I think this is the Fed's been saying, higher for longer.
I think so too, Joe. And I think even if the inflation comes back, it lowers a little bit at the beginning of this year and then comes back, I don't think they raise the rates to compete against it at all. I think they just freeze where they're at. So we're going to have inflation and crashing markets, Joe. They're going to have both. I don't see how we don't get both. I don't see how inflation stops. The situation we have with the debt and all the money that they printed, and then I think they're going to continue to print money. And I think it's not going to be out in the open. They're not going to say they're printing it as much. That Fed balance sheet will go up, though. Well, I think we'll have that indication. And then what are they going to do, Joe? I think stagflation is the future, with a lot of prices going up and everybody's income staying sideways, Joe.
We'll talk about that. And, well, peasants and lords, I got an update on the peasants when we get back. 800-951-0592. Joe and Jason, Patriot Radio News Hour. $20 gold at $21.15. U.S. Silver Eagle rolls. That's 20 U.S. Silver Eagles, $7.30. And then the cheapest silver we have, rolls of dimes, silver dimes, 50 silver dimes. And those are at $110 at 800-951-0592. And we've talked about, think about really what's happened over the last 50 years, about what's really happened in America. We've had a massive expansion of debt that the world's never seen. I mean, in 1971, the debt was $400 billion. We do that on a bad month now, right? We celebrate that we only had $1.4 trillion of debt last year. But here was the problem with that number. The Fed was buying a whole bunch of adding to their balance sheet on top of it, pretending like that wasn't. It's all a farce. I mean, we've got over $40 trillion worth of debt. But what we've seen, Jason, is a huge slide in the standard of living of people in the United States. And it's covered up by huge amounts of government spending. We've got more people dependent upon the government than ever before, and it's growing. Even when they say, oh, wait, it's good times, these numbers grow. Medicaid.gov. So you got Medicaid, you got Medicare. Right? Medicaid, that's for the poor people. As of August 2022, so this number's a little old, 90,550,412 individuals enrolled in Medicaid and CHIPS. And CHIPS is kind of what simply put, Medicaid for children, the Children's Health Insurance Programs. According to the data, they're saying that the most recent number, because that was the government's August number, the number now stands at 96.2 million Americans, and they're anticipating that by the end of January, Jason, somewhere between the end of January and mid-March, we are going to surpass 100 million people in the next 70 days or so that are going to be on Medicaid or the Children's Health CHIPS, which I call Medicaid for children. Think about that. I mean, we only got, 330 million people or so in the country. It's an incredible number.
It's interesting. I was having a discussion the other day, Joe, about standard of living, or actually, I kind of lean this one towards we're coming into, I think, in America, a real discovery of value and price. After World War II, when the dollar, the Federal Reserve note, became the world reserve currency, I think America enjoyed several decades of artificial standard of living, way above the value of things. I think Americans, I know the one parent working and paying for everything. I mean, you could go work at McDonald's essentially and pay for a whole family of four. I think because of the world reserve currency change that happened after World War II, I think there was an artificial standard of living in America. I think by the time, Joe, you get to the 1970s, I think 1971 is a good number. By the 1970s, I think the standard of living was still very high versus other countries, but I think it was getting to be more the value of things. I mean, think about the 1970s. Anybody that lived back then, and I can just go off of what I've understand and I've read. The value of what you paid for and the things that you bought, the price of a house, the interest you had to pay on things. Not everybody had a credit card and was in debt. I think everything was kind of standard. The quality of items you bought, the quality of houses, the quality of things you buy at the store were equal to the 40s and the 50s. You had decent quality stuff. I think what you've had, Joe, since then is slowly but surely a shrinkflation. The prices of goods and services kind of stayed pretty decent, but the quality went down, which is hiding the fact that we were losing our standard of living. Now, Joe, we're at a place now where the quality of the stuff we buy is so low, and now it's getting really expensive. We shouldn't be paying. I bought 2 quarts, not even a gallon, 2 quarts of paint to get some stuff done at my house. They were $30 per quart. I think that's as bad as the Federal Reserve, as devalued as the dollar is. That's the value. That is the value. How decimated the dollar is. It wasn't an easy thing back in the 70s, in the 60s, and so on. You didn't just go to a big box store and just buy everything, put it in a cart, and run off with it. It just wasn't that easy. The quality of the stuff is down. The prices are now going up for lower quality junk items, Joe. I mean, when's the last time you went to a store and saw quality things, Joe, to buy? And when you find quality,
what's so funny?
How much is it?
Yeah, what's so funny? I was talking to them the other day. My wife and we bought eggs. They were $7 a dozen, right? And that was not the most expensive eggs there. Nope. The problem, and Jay's talking about quality. Here was the problem. There was one egg, and it was, and I forget the price, but I want to say like $3.79 or something like that. So the lowest quality that they had, but they didn't have any. They were out. Right. I mean, so it didn't even matter what the price was or the price. It's just not there.
Joe, remember we talked to Gene Kuntz on a Half Empty Cup of Joe, and he was talking about basically your charge in your body. And he said, hey, by the way, you really shouldn't have rubber soled shoes. You should have leather soled shoes or other materials, not rubber. Well, that's what we've been using, especially the last 50 years is, hey, you get a pair of sneakers and it's rubber soled, and that's a lower quality. You used to have shoes that were leather, and then when the soles got worn out, you would take it to a shoemaker. He'd take that sole off and put another on. So I was pricing. I wonder what a good pair of leather shoes were. Actual something that you would wear for decades. Even what people would buy shoes. They wear shoes for years and years. That was your shoes, right? $800, and some of these shoes are $1,200, Joe. You can maybe get an okay pair of standard old style leather shoes for like $600. Think about that, Joe. $600, $800, $1,200 for a set of actual shoes that you would have wore in the 1800s and the early 1900s. Can you imagine, Joe?
Yeah, it really is amazing. Robert Kiyosaki, we talked about him last week. Jason, he's come up with an update. And I've been telling everybody he's been moving up his forecast. So you go back to he started talking about get ready for the big gold and silver run. And he was talking about that in the summer of 2022. And saying, hey, in the next 3 to 5 years and then 10 years. And all of a sudden, he's been moving up that 3 to 5 years has been ramped up. And now when we get back, he just gave his latest update on where gold and silver prices are expected to be this year. You're not going to want to miss it. Stick with us. 800-951-0592. Joe and Jason, Patriot Radio News Hour. Silver dimes at $110. Silver Eagles $730. $20 gold $2,115 at 800-951-0592. And yesterday, Jason and I were just like, pretty simple. If you want to pay more for your gold and silver, then wait, right? Just wait, right? Because you'll pay more in March and June and July and August, September, right? Robert Kiyosaki, we are talking about this for quite a while, and he's updated where he thinks prices are headed. He's now saying this year, gold to hit $3,800. Essentially, Robert Kiyosaki saying, listen, gold is going to double this year. Silver. Now this one, and again, I try to stay out of the predicting, but this guy, listen, he makes his money by telling people what to expect. He's saying silver could be $75 before the end of 2023.
Wow. Joe, that just screams to me one thing, because these types of moves only happen when there is a smokescreen of a fake or otherwise emergency. So that means something big is going to happen. We can just guess. Well, we all know pandemics or wars or whatever, 9/11 type events. That kind of a move, Joe, that happened this year, I don't doubt that can happen. That always is accompanied with an emergency to get people looking the other way, Joe. And they can blame it and point the finger at it.
And let's say, okay, wait, 75. All right, well, 35, 40, 50, right? This is something where he's not saying, hey, I expect silver to be $25, right? And, here it is at $23 and change today. And again, I hope he's wrong. And I say that because if he's right, then what Jason and I are telling you, right, we're wrong, right? We're being too optimistic right now, Jason, with if Robert Kiyosaki is saying $3,800 gold and $75 silver, that means not only did we get job losses, we got the stock market crash, housing crash, right? We're talking the whole shooting match. We're talking about reliving the financial crisis all over again. The difference is, Jason, now we got the new rule, right? It's not bailouts, it's bail-in.
Well, Joe, that little email that I read from the guy looking at the properties being scooped up, I think I agree with, under Robert Kiyosaki's pricing, I would say housing goes sideways. Once again, I think the prices of things are going to stay strong.
I'm just saying for where he's saying stocks, bonds, real estate, all crash. And again, we'll wait and see. But again, listen, if we get the big job losses that we saw back in the financial crisis, there's no doubt in my mind. You just get housing crashes, everything crashes. I just haven't seen that yet, but it's something that, yesterday we talked about the manufacturers, 9 straight month of declines. Haven't seen that since 1973, 74. Today, we got the service sector number. So the service sector PMI, the 6th straight month in a row. 44.7 was the number. 50 is like even. So we're falling farther and farther into contraction. And it's just mind-blowing to see, normally you'll see, okay, well, you'll get 1 month, right? Just because of accounting or a weird month, calendar year, something, the government ordered 1 million planes or something like that to get a 1 month positive. Jason, we're not even getting that. But here's the funny thing in that PMI data. Companies were still hiring. Even with the 6th straight month of declines.
Joe, during the Depression, and you would think since nobody had money that the prices of things would go down. Prices of many companies, a lot of people went bankrupt, but the prices didn't really go down on food. They had food rotting in the fields. Prices of food did not go down. So I think certain sectors, Joe, are going to be inflated and prices are going to stay strong, and other sectors are going to be completely decimated and have no value at all. That's what's going to happen. I don't say that the housing prices aren't going to go down significantly because I bought a house. I don't want my house price to go down. I remember when I bought my first house in 2000. It was the end of 2004. So when the housing crash happened, the price of my house went down. I didn't really care. The way I looked at it, my mortgage was just cheaper than a rent anyways. So with the house I bought in 2020, I don't care too much about obviously I don't want my house going down to like $100,000 or something, but that's just not going to happen because the cost to build a house is a certain price. Those goods, the wood, the glass, the metal, all the concrete, those things aren't going down. And so Joe, I think Robert Kiyosaki making this prediction of where silver and gold is going to go is just showing you that certain sectors are just going to be unimaginably expensive. And if you can't afford it, too bad. We really are heading for that, Joe.
Yeah, well, again, I know that he talked about the gold premiums, the silver premiums, and said, don't be an idiot, pay them because it's going to get worse. But the nice part is the premiums are really have come down into a very much better level than what we've seen over the last few years. We'll see how long it lasts. But again, it's one of those things where I guess it's going to be the degree. How everyone knows it's going to get worse. The question is, how bad does it get? Robert Kiyosaki saying, hey, it's going to get a lot uglier. Patriot Radio News Hour. We'll be back after the break. (800) 951-0592. Joe and Jason here. Dow's down 415. The S&P's down 43. The Nasdaq's down 113. Gold's down 23. Silver's down 64 cents. Copper's up about 6 cents. And crude oil is up. Now, granted, crude oil had a tough day yesterday. We did get crude oil inventory numbers. We had another, a small crude build, but a bigger decline in gasoline inventories. Kind of a wash. The problem, Jason, still taking almost 3 million barrels out of the strategic oil reserve.
Yeah, that's we'll see, because you've mentioned, it's obvious the winter is less driving, but we're still dipping in. So what's that going to look like when May and June roll around, right, Joe? Are we going to still be doing that level, or are we going to take more, or how much is going to be there to begin with, right?
Yeah, and again, we're at the lowest levels in over 40 years. When it stops, I mean, at what point do we stop? I want to say we're now down to 383 million barrels, 383, and I'm just doing some quick math here. That's about 18 days of supply now. So we've broken through less than 20 days, and now we're down to about 18 days. I guess if there's a positive, they were releasing between 7 and 8 million barrels. Now it's around 3 million barrels. But again, Jason, it just doesn't bode very well when winter ends and that springtime and that summer demand, especially if there's not job losses. We can see oil get very high again come that April, May, June time period.
What do you think the price of oil will be at that point? Seeing where it's at now, I mean, how fast do you think it would go up by that time? Well, I guess it depends what happens in the markets too in the next couple of months.
It does. I mean, listen, if it stays the way it is, okay, what we've been seeing, yes, we've had a slowdown in jobs. We're still creating 250,000 jobs, and wages are still hanging in there. They're still growing a little bit slower according to ADP, but still growing. easily over $100 again, Jason. Easily. Got to remember, we caught a break. We actually caught two big breaks this year. No big hurricanes, at least not where it mattered. The one in Florida didn't get into the refinery areas. And then China was essentially at least 300 million people locked down pretty much all year long on their rolling COVID lockdowns that really prevented oil from getting really ugly. This time around, China stays open. We kind of hang in there, and you can't use the strategic oil reserve anymore. I just, again, there's no reason. I mean, 100 plus, 120. I mean, we're going to go back to $4 and $5 a gallon. And again, unless we start seeing big layoffs, and we haven't seen them yet.
Makes you wonder if the China shutdowns were timed just to open up for this coming market stress that we're having. Well, if they were open all year last year, would this thing have already happened, Joe?
Yeah, and again, I don't know. It'd be interesting to see. But anyway, 800-951-0592. Jason, we got one more show tomorrow. Check out our YouTube channel. We'll be doing some giveaways again. And everyone just, listen, keep adding. Even if Robert Kiyosaki's only half right on his predictions, man, you'll want to be buying today. Jason and I, we're coming right back with the Half Empty Cup.